Good morning, everybody, or afternoon, or evening, wherever you are. It is Tuesday at 6 p.m., which means it is time for Tax Sherpa Live. This is office hours. So first, let me make sure that the stream is actually working. So I'm going to go to restream here. And okay, we seem to be working. Today's going to be kind of an odd one uh, because I'm probably going to cut it short. Normally we do these for an hour, but I'm flying solo today. And also, there was an interesting thing that came up that I wanted to go over. So normally this is where we go over questions and answers that we have, or questions that we've received from people either on our private groups or from clients or calls that we've had over the last week or so, and then I answer them. And I answer to all task questions is the same. It depends. And what we're going to be talking about today is going to be a great example of how it depends. So welcome everybody. If this is your first time, I'm Neil, your host. I'm the founder and chief tax strategist here at Tax Sherpa. So I got into this whole tax game through owing a bunch of taxes. Back in 2007, I started getting nasty letters from the IRS saying that I owed them over $1.3 million. And like most people, especially like most entrepreneurs, I ignored those notices. And I know that sounds crazy in retrospect, but that's what I did. I figured, this isn't right. So I'm just going to bury my head in the sand and it'll go away. So if you've never been through the process, here's what happens. First, you get letters. And then if you ignore those and the number's big enough, then you start getting certified mail letters. And if you ignore those, the number's big enough, you'll start getting phone calls from revenue agents. Mine was named Joyce. And if you ignore those, then they'll start going after whatever it is that they can find. In my case, I had a paycheck. I was getting a W-2, a small W-2 at the time. And so they garnished my paycheck. And then I couldn't afford to pay rent. So at that point, I decided to actually fix my problems and ended up hooking up with a former Wall Street tax attorney. And he really showed me the ropes when it came to the tax world. And I helped him over as his business was growing. I helped him institute some of the entrepreneurial learnings I picked up in the previous 10 years at that point. And that was 15 years ago now. So over that time, I've worked on over 50,000 tax returns and billions of dollars worth of client earnings and have kind of seen a lot. So the case that we're going to be going over today, that's what we're going to do, is kind of a case study. The case that we're going to be going over today is kind of an interesting one because it's one I don't come across very often. I've seen it, before, but it's so what is the word? It's pretty unusual. Let's put it that way. And yeah, so what we're going to do is we're going to step through a particular client situation. Obviously, names and well, there won't be any names, but numbers are changed just to make the examples easier. And the the thing about it is that not only was it a waste of money, at least in my opinion, but it is actually against IRS guidance, which is kind of interesting. So normally, IRS guidance wants you to pay more, but in this case, they actually want you to pay less. So it's kind of an unusual situation here that both us, Tax Sherpa, and the IRS are actually on the same side of the issue of this one. We've had plenty of situations where we're on opposite sides. We think things should be one way, and they think things should be another way. But in this case, we're both on the same side of the issue, and that's a great thing to think about when it comes to the tax world. So in taxes, this is where the numerical areas of accounting meet the non-numerical areas of law, and this is an underappreciated point. So law is, at least in the common law system that we have here in the United States, is not a black and white kind of thing. A lot is going to depend on definitions and intentions and facts and circumstances. And that's why when you ask lawyers or tax people or accountants, what about this, that, and the other? They're going to say, well, it depends, because if this, that, and the other were true, then it's this way. And if these five other things are true, then it's another way. So it's really critical to understand that concept. my favorite example is the upcoming disaster that is coming with the 1099Ks. So a 1099K, bring that up here. Form 1099K. Let me switch to the browser view here. Understanding your Form 1099K. So, well, this is what they look like. So, this is the payment card and third-party network transactions. And this is the March 2024 version of the form. And what it does is it'll list the filer is going to be, Transdata or First American or Airbnb or PayPal or Bank of America or any processing, um, payment processing organization. And then the payee is going to be you. And it's going to have, name, address, social security number. That's the TIN, taxpayer identification number. And the most important number on this whole form is box 1A, gross amount of payment card slash third party network transactions. So this is the dollar volume that went through whatever platform is reporting it on behalf of this taxpayer. And this number needs to be reflected or greater on a tax return. So, an example, if you have an Etsy business, right, and you collect payments through Etsy, and you do at least 200 transactions during the course of the year, and the total volume is at least $20,000, you get one of these forms. And it's going to say Etsy processed whatever, $47,320 on behalf of this taxpayer. So whatever this taxpayer is needs to report at least whatever the amount is in here in order for there not to be a conflict in the IRS computer systems. If the amount reported on that for that taxpayer does not reflect at least that much, there's going to be a letter. And they're going to say, hey, you didn't include this income, you owe us additional tax. So these are critical to get right. Now, why do I say there's an impending disaster? That's because one of the rule changes or law changes from, I believe it was the CARES Act, was that the old rule was 200 transactions and $20,000. Both of those conditions had to be met in order to generate one of these forms. And so a place like Airbnb, if you're doing a short-term rental, you might have 40, 50, $80,000 worth of transactions flowing through Airbnb on your behalf, but you only had 50 transactions because, there's only so many stays in a given year. And so you didn't meet both thresholds, and that 1099K form was not generated by Airbnb. So part of the changes, though, is that the new rule, and this was supposed to go into effect 2 years ago, the new rule is the total volume of transactions has to be greater than $600, and that's it. So now, if you're an Airbnb host and you have at least $600 worth of payments flowing through Airbnb on your behalf, you're going to get one of these forms. That's not really the problem, because if you are an Airbnb host, I mean, hopefully you are reporting your taxes correctly, and you were reporting that income anyway. So get a form, don't get a form, whatever. Doesn't especially change anything. Create some more paper, but the IRS is all about creating more paper. So the problem comes in when people are using payment platforms for non-business purposes. And what is that? It's like, well, I paid my kid's Girl Scout meeting dues on Zelle, or no, sorry, on Venmo. So I paid whatever it was, $50 for the year, and that went to somebody, and that somebody might be getting a 1099K now, even though that is not business income. There is no place on a tax return to report non-income amounts. So we are still waiting from the IRS as far as how we're going to handle all this. The latest scuttlebutt that I've heard is that it's going to be a Schedule 1 adjustment. Schedule 1 is adjustments to income. But it's going to be a disaster, and they're expecting like 30 million of these forms are going to be generated this year. Now, like I said, it was supposed to go into effect 2 years ago, and at the very last minute in both the last 2 years, the IRS has kicked the can down the road. It says, oh, well, our industry partners aren't ready, so we're going to delay this another year. We're going to delay this another year. They're saying this year they're going to do it. So for 2024, and when the filing season begins in January of 2025, millions of these 1099Ks are going to go out. to people who were not expecting it. Because besides me, I don't know how many people are actually talking about this issue. Anyway, so you go out to dinner, and your friends reimburse you because you put the tab on your card because you wanted the points or whatever, and your friends reimburse you through Venmo or Zelle or Cash App or any of the other ones, and then over the course of the year that adds up to more than $600. Now you're on the hook for one of these 1099Ks. So people are going to panic. It's going to be a problem, and there currently is no solution. So that's fine. But that's a great case where it depends. Because getting reimbursed for money that you spent on dinner is not income. Getting a loan from your uncle through Venmo is not income. Uh, I also pay my lawn guys through Venmo. That is income for them. So it all depends, right? Depends on the facts and the circumstances. Even though the transactions are the same, it's a payment through a third-party payment platform. But what was the intent behind it? That is an underappreciated area when it comes to tax because it's that intersection of law and numbers. Anyway, that's not even what I wanted to talk about tonight. But so what I did want to talk about tonight was when you take too much salary. So this is Lucid, by the way. This is a platform that I use for mapping out stuff. It's pretty great, honestly. I use it a lot. So here's the thing: if you are a taxpayer, you're an individual, whether you're single or married, you're going to file a 1040. If you have a business, could be an LLC, could be a corporation, whatever. Um, Most of the time, the correct way to treat that for tax purposes, and when I say correct, I mean there's options, but as far as like the most efficient thing to do, is going to be an S corporation. S corporation, and that files a form called the 20S. So, well, while we're looking at forms, let's look at form 1120S. Man, I used to be able to type. I don't know what happened. All right, so this is Form 1120S. It's going to have a name, name, address, tax ID number, date incorporated, the date the S corporation election was done, of what date's effective, assets, business code activity, and then here on the front page, this is the majority of the return. There's other stuff, but it's the majority. You have your income up here, and then you have your expenses, and then this stuff is almost never used because this is a pass-through entity, meaning that the company is not going to pay taxes, at least in most states. There's a couple notable exceptions. But federally, it's not going to pay any taxes. And this number down here at 22 here, ordinary business income, is going to be a number that flows through on Schedule K1 to the owners. And it's going to, so let's say this number is $100,000. Okay. Now, if there's two owners that are 50-50, each one will get $50,000 on their K1s. And that income will get included on their 1040 and it will be assessed at whatever their rates are. This is the most efficient way to do it for two reasons. So reason number one is that there's a deduction called the qualified business income deduction. And this applies to all passes. It applies to Schedule Cs, it applies to partnerships, which files Form 1065, and it applies to S corporations, which file 1120S. And what it does is it's a deduction for up to 20% of the net income from that entity for that business owner. And it's an incentive for people to do business, right? All of the tax code is carrots and sticks. It's incentives and disincentives. So this is one of the incentives in order to improve business activity, right? So huge tax breaks for business owners. Now, the other part that makes S corporations better or more efficient than most other forms is that whatever this number is that flows through to your personal tax return does not carry self-employment tax. Now, self-employment tax is what self-employed people do, or what self-employed people pay in replacement of Social Security and Medicare. So it's the exact same tax. It's just called self-employment instead of payroll tax. So because of that, there is a 15.3% incentive to have income come through on a 1120S K1 versus anything else. Because Doing it this way, I don't have to pay self-employment tax. Doing it other ways, I do. Right? So makes sense. It's worth the election because it's just filing paperwork. It's worth the election to file with 120S. Now, obviously, Congress is aware of this. They're the ones who made these rules. And so there's a balancing rule called the reasonable compensation. What the reasonable compensation rule says is that the owners of an S corporation who provide services in the context of this company have to pay themselves a reasonable salary or reasonable compensation in order to capture some of those payroll taxes. Because if this company pays the owner a W 2, then on the W 2 portion, that owner will be paying payroll tax because it's a regular payroll, right? And so that's going to, so whatever amount is on W 2 will typically be reported here on line 7. And that amount is a deduction to the company and will be income to the owner. And that's going to reduce the amount that's available for the pass-through income. Okay, so basically, you lose QBI on qualified business income deductions on the W 2 portion, and you lose the exemption or the avoidance of the payroll tax or the self employment tax. So here's the thing about reasonable compensation reasonable is not defined anywhere. There have been court cases, and I can give you some quick tips. So, one, it should not be a low round number. So, don't make it like $2,000 a month. Don't make it $3,000 a month. Make it something reasonable. And one method that has survived in tax court is to actually do an hourly log. So the thing about business owners is that there is no one job that the business owner does. What you want to do is you want to try to get a measure of how much it would cost to actually hire out your services for the different time you spend doing different tasks. So especially if it's just you, you're going to be chief cook and bottle washer. You're going to be providing the service that you actually provide. So maybe you're a graphic designer or a consultant or a plumber or whatever. If you had to hire somebody to do those services, that's one rate. You're also going to be doing marketing. You're also going to be doing sales. You're also going to be doing tech support. You're also going to be doing admin work. You're also going to be doing customer service. So all of those have different rates. So what you want to do is keep a journal throughout the year, or not necessarily throughout the year, but take a sample, like a couple weeks, and break it down. Say, how many hours am I actually spending doing all these different things? Go out into your marketplace. You can look on the salary websites and try to calculate what it would cost to actually hire somebody for that number of hours for that pay period, and then annualize it out so that you get a blended average of all the different jobs that you're doing. And then if you have that, that's a real defensible, reasonable compensation. However, that's not what we're talking about today. So what we're talking about today is an unusual case where the reasonable compensation was too high. And that very rarely happens. And it's clear that it's too high because it generates a net loss. So let's say this number is $100,000. I took a W-2, and this number is negative 75,000. So it doesn't matter what everything else is. That's just how it ends up, right? So I took a $100,000 W-2, and I ended up with a net loss of $75,000. So on an income tax perspective, this nets out to 25 grand, and I'm going to be paying income tax on that net. However, this is against IRS guidance. It's against the establishment of reasonable compensation. And there have been a number of court cases about this. Basically, when the courts have found these kinds of situations, they reclassify this down to 25,000, and this goes to 0. Okay? And there's a couple different reasons for this. So one is that in the court history, in the precedent of developing, this definition of reasonable, which again is not actually defined anywhere, then the financial condition of the company is one of the things to take into account. So that's a fancy way of saying the company has to be able to afford to pay. But this is 2, and this is going to be net profits. Okay. Now net profits get split off into, there's a QBI deduction, tenth of anyway. There are certain exceptions to that. And the rest is going to hit the 1040 as taxable income. So in the optimum case scenario, this is going to be 20%, and this is going to be 80%. All right. Now, the W-2 portion is going to have payroll taxes. Let's say EE payroll taxes. And the employer is going to pay employer payroll taxes. Be 7.65%, and this is going to be 7.65%. Okay, and then the remainder is going to go here, and that's going to be whatever, 92.35%. Okay, so we're already getting complicated, right? So this is the normal situation. But when this becomes negative, then the QBI, well, one, QBI goes away, and two, this is much higher than it should be. So why is this a problem for the IRS? So part of it is the is the um, is the reasonableness, but the other part comes into sheltering retirement funds. Because another condition, if you are contributing to retirement funds as an S corporation owner, the limiting factor is the earned income portion. Because anybody who gets a W-2 and has, let's just say a 401k, because that's going to be the most common scenario. Anybody who has a 401k at their work, they can contribute a portion of their salary into this deferral. And for 2024, the limit for the employee is $23,000. So, owner here could put an EE 401k contribution, and this could be up to 23K in this year anyway. However, the employer can also offer a match. Now, an employee, any employee, can contribute up to $23,000 over the course of the year. The total amount allowable to be contributed to a 401k in that person's name is $69,000. So where's the difference? 23,000 over here, total is 69. That leaves a gap of 46K. Where does that come from? It comes from employer matching. Now, if you work for a company that you don't own, you're not going to get 46K of matching. You're going to get, 3%, 5%, 2%, whatever. It's not going to be twice whatever you put in over here. But if you own your own company, you can do that. So let's go up here. So this is the ER 401k contribution. Now, this could be 69K. Or no, sorry, total 69. So this would be 46K. However, there's another limit. Limit is that this amount is limited to 25% of this amount. So the higher this number is, the higher this could be. And now you have sheltered or deferred income taxes on a huge chunk of money, this 46K. And the IRS isn't a huge fan of that. I mean, it's part of the rules, but if you are deemed to have created excessive income here through a W-2 that generates a net loss over here, then you're enabling yourself to make too high of a retirement plan contribution. So that's problem number two with the idea of generating excessive owner compensation. So excessive meaning beyond reason. So when we get back to the reasonableness, there's all these different factors. One is the actual job being done, and then a second is the financial condition of the company. So basically, the company has to be able to afford to pay this. And if you've built up profits over a number of years, then maybe you can make a case that it can't afford to pay this, and it is worth paying this much as a salary. But, you know, it's just inefficient. So generally, what you want to do is you want to have some W-2 and some profits. And the exact split depends. Depends on the circumstances. Depends on all those different things that we already went over. And so based on that, though, we can contribute to a 401k, and we can contribute to both as employee and employer. So let's put some numbers to this to kind of make this make more sense. All right, so let's go over here. Let's make a copy. And let's say, okay, let's say this company makes, I don't know, 500 grand. That's the revenue. Now, when you talk to a tax person, we don't especially care about revenue. We care about debt. It's not how much you make, it's how much you keep. And we're going to have OPEX here of, I don't know, let's say 50%. So, let's just say 300K. OPEX, 300K. So if 500 comes in, 300 goes out, that leaves 200 for us to do something with. Okay. So let's just say that in our first round, we would look at this and we would say, if this is 250K, this would be negative 50. And you look at that and you say, does that make sense? Not really. Because why would you pay somebody more in order to create a loss over here? It just doesn't really work. Instead, let's say, I don't know, let's say this is 75K and this is 125K. So it still adds up to the same 200. But now the math starts to change, right? So we can put 23K of the 75 over here. The payroll taxes do not factor in the 401k contribution. That's something a lot of people don't appreciate, actually. So if I make 100, I put 23 into a retirement plan, I still pay Social Security and Medicare on the 100, even though my income tax, which is a different tax, I pay on the reduced amount. So I don't know, what is 7.65% of 75? That's 5,800 bucks. I'm just going to call that 6K for rounding. And then that leaves, for income tax purposes, we got 75 coming in, we got 23 going out, we got 6 going out. Well, actually, for income tax purposes, the 6 doesn't matter. So that's going to be 52 for income tax purposes. And this over here, this over here is going to be 6 grand because the employer and the employee split the payroll tax. So this amount is pretty much always going to be the same as this amount, employee and employer payroll portions. Okay, but now I've got this 125 to deal with. So before I get into my QBI and everything, I want to think, well, can I contribute 46 grand to my 401k as an employer match? The answer is no, because this contribution is limited to 1/4 or 25% of whatever this number is. Basically, it's limited to 1/4 of the amount that payroll tax was paid on. So 75 divided by 4 is 18. I'm just going to round. We'll say 19K there. And but this right here is an actual corporate deduction, as is the payroll tax for the employer. So this is no longer 125. So we take the 125, subtract off the 6, subtract off the 19. This actually drops to 100. So by the employer matching, the flow through gets reduced. The total amount hitting the taxpayer is reduced. That creates tax savings at the individual level, even though it's a corporate deduction. Okay, so now I'm going to wave my hands here, and I'm going to say that this is not only 20%, but it's also 20K. because that's the max we could get on $100,000 worth of net profits. And incidentally, doesn't matter whether you take the money out or not. If the S corporation filing this form has $100,000 down here, and I guess we can fill this up at 500,000. And this is other deductions was 300. So here's how it starts to fill out. So taxes, 6 grand, and pension and so forth is 19,000. Let's see, did I do that math correctly? 500 minus 85 minus 6 minus 19 minus 300 is 100. So yes, this is the reflection of this diagram here. So now we have $80,000 hitting the 1040 as taxable income. And so, what we had was $200,000 here, but over here we only have, remember 80 plus 52 is 132. So that's kind of surprising, right? So 200K of discretionary earnings turns into 132K of AGI, adjusted gross income. Because we were able to shuffle off taxable income into the retirement plans. And we did that through having the W-2. So we want to optimize the W-2 so that it's reasonable, it's defensible, and it provides the ability to contribute to retirement plans. And I will tell you, for those people who are saying, well, which retirement plan is right? Usually going to be 401k. And the power of the 401k is actually this right here, that you're not just relying on the 25%. Because if this were an SEP, for example, or a simple IRA or any of the other ones, you're limited from the employer side to just the 25%. And you don't have the employee contribution. So that's what makes 401ks more powerful, or 403bs, similar kind of thing. That extra employee contribution really bumps up the power of the retirement plan. And so if we turn $200,000 into 132,000, and yeah, okay, we pay 12 in payroll tax along the way. That is true. So even if you wanted to count that, it'd be 144. So 200 minus 144. So we sheltered $56,000 of income between the retirement plan contributions and QBI. So, how much is that worth? Well, it depends on your marginal rate. If you are in the 24% bracket, then that's going to be worth $13,000 to you. It's $13,000 in your pocket that you didn't have to pay for. That you didn't have to pay the IRS. And then, whatever your state rate is. The average state is going to be 5%-ish, but some have 0, some have 13. So it depends on where you live. If you're in the 32% bracket, then 32% of 56,000 is $18,000 that you didn't have to pay to the IRS. If you're even higher, then it goes higher. So it all depends, right? It depends on your particular facts and your particular circumstances. Which bracket you fall into is going to depend on the total income, the character of that income, and your filing status, whether you're married, filing joint, married, filing separate, single, head of household, qualifying widow, or widower. Which is qualifying widow is basically just married filing joint for an extra couple of years. They give you some leeway on the timing there before you convert to head of household with children. So, that this is the right way to do it effectively. And again, numbers, I'm just making these numbers up for example purposes, but this is kind of the process we go through in order to start figuring out what pieces we want to play with. Now, there's other things that would go into some of our standard tax advisory plans, including tax-free strategies to reduce the income before we do any of this work. Because the general path that we go through is you're going to have your revenue, you're going to have your expense, your operations expenses. So first thing we're always going to do is entity optimization. What entities should we have? How many of them should we have? and how should they be treated for tax purposes? Because there's choices. From there, we go into generating tax-free cash flow out of those businesses. And that can take various different forms depending on what exactly is going on in the businesses and if there's assets and real estate, those kinds of things. Um, After that, then we go into uh, payroll optimization or compensation optimization, where we can start to layer in. It's like, well, how much should go here? How much should go here? Based on this amount, how much can we put into the retirement plans? And then, based on the overall factor, how can we maximize the QBI deduction? And then we end up with some amount hitting the 1040. And then we go into the fourth layer, I guess it is, of what I call the exotics, where that requires outside parties. All of this can be done completely within your control if you have your own business. But there are strategies that involve other parties, like buying tax credits is a simple example. There's a whole secondary market out there for people who have generated tax credits, can't use them, and then sell them on the marketplace for, typically a percentage of, the tax savings. Tax credits are really great in the simplicity of them because there's a credit for $100,000, let's say, and I'm going to sell it to you for 70. Well, you give me 70, I give you 100 on behalf of the IRS, effectively. So you're profiting 30, which is a pretty decent deal. So everybody's happy, and Congress creates these credits because they're trying to achieve some goal. The current hotness in my world is all the solar stuff. There's tons of solar projects being built that probably shouldn't be. All the strict energy production economics of it, but they carry tax credits, so people are incentivized. Again, it's carrots and sticks. That's the whole tax scheme. And this is one of those carrots that Congress creates in order for people to do the things they want done. And people are doing those things because the benefit that they get when you include the tax incentives is greater than the economic benefit of the actual business. So that's how tax credits work. But it's they're very simple to understand because credits work dollar for dollar on your tax deductions, and so like there's all kinds of interesting deduction strategies out there that involve third parties like this. So one you got to really watch out for is conservation easements, and there's been a lot of conservation easement fraud. This is where you set aside a piece of property into an easement so that it can never be developed. So it's conserving the natural beauty and all that kind of stuff. And you have to be very, very careful that one, the property exists, and two, that it's worth what they say it is when they put it into the conservation easement. And you got to make sure you got the appraisals done and all that kind of stuff. So you want to definitely do your due diligence on those. But deductions are more complicated because that's going to reduce your taxable income by whatever amount the deduction is. And that's going to have a cascading effect on your tax because, as income goes up, the bracket goes up. But as income comes down, the bracket goes down. So if you're a 35% taxpayer and you take a huge deduction, you might end up as a 22% taxpayer. But those last dollars were not taxed at 35%. They were taxed at 35, and then 32, and then 24, and then 22. So the net savings is not going to be just 35% of whatever the deduction was. It's more complicated than that. And then there's other aspects of like some deductions are only against passive income, and some are against ordinary income. It's complications like that. So deductions are more complicated from a benefit standpoint than credits because credits, you pay me 70, I'll give you credit worth 100, you go get your 100 from the IRS. Pretty simple. So that is kind of how it works. So anyway, that's kind of what I wanted to go over today because it was a pretty interesting case that I've run into a few times over the years. But the reason it doesn't happen very much is because most people don't have that much cash in their business. And we can maybe another time we can get into the issues with holding excess cash because you could potentially be penalized if you don't have a business purpose for that cash. If you do have a business purpose, it's fine. Berkshire Hathaway, Warren Buffett is famously holding, I don't know, $40 billion worth of cash or something like that. That number actually might be low. It's been a while, but they have billions and billions of dollars worth of cash on their books. So normally you would say issue a dividend because you're supposed to, you know, that's how it's supposed to work. But if there's a business purpose for that cash, in Berkshire Hathaway's case, it'd be for an acquisition, um, then that's okay. But if there's no business purpose, then you're supposed to distribute that money and get it working in the economy. But that's a bit far afield of what we're talking about here. So most businesses can't afford to run the owner compensation at a loss for the business because they don't have enough money. But some do. And I've seen this, probably 15 times over my career, and it's always a mistake because not only is it against guidance, but you're also paying payroll tax on all that excess W-2, which is just a waste of money as far as I'm concerned. All right, I know we're about 20 minutes early, but I'm going to cut it off here because I'm actually on I'm supposed to be on another call that is going over newsletters and how to make our newsletters better. If you want to join our newsletters, go join the Tech Sherpa Explorers, and you'll get access to our internal forum as well as a bunch of a bunch of courses and custom AI stuff that I've built, and I'm continually releasing new things. But otherwise, see you next week. So Tuesday,